There is a shockwave moving through the economy right now. Most people cannot see it yet. They think the crisis is over because the headlines have moved on. They hear the word ceasefire and they assume the bills stopped growing the moment the shooting slowed down. That is not how the real world works. By the time the television starts calming people down, the real damage is usually already inside the pipe, moving from one part of the economy to the next. That is what I want you to understand today. Because if you understand the pipe, you understand why so many people are about to feel poorer long before they understand what actually hit them. The first mistake people make is assuming the story ended when oil stopped screaming upward every day. It did not. When tensions around Iran escalated, Brent crude surged above $140 a barrel in the source framework. Then it pulled back. It settled into a lower range. The headlines relaxed. Traders started behaving as though the worst had passed. People looked at the screen and thought, all right, the emergency is over. That is a market reaction. It is not an economic conclusion. Oil can fall off the peak and the economy can still keep absorbing the damage for months afterward. In fact, that is usually how it works. The first move is in the commodity. The second move is in contracts. The third move is in margins. The fourth move is in consumers. By the time the average person notices, the shock is old news to the people who live closest to prices. That is the first rule. A price spike can end on the screen long before it ends in your life. Now let me show you the chain. When oil hit 140, every trucking company, every shipping company, and every heavy logistics business in the country had to react immediately. Fuel is not some side expense for them. It is often the largest moving cost in the whole operation. So they raised fuel surcharges. They had to. And this is where the public misses the plot. Fuel surcharges go up fast. They do not come back down fast. They are sticky. That is one of the most important words in this whole discussion. Sticky means the cost gets embedded. It attaches itself to invoices, shipping agreements, freight schedules, and vendor expectations. Even if oil comes off the panic high, the surcharge does not politely disappear the next morning. It lingers. It becomes the new working assumption. It becomes part of the cost structure. Now, that extra cost does not stay in trucking. It moves. That is why I call it a shockwave. Think about the chain like a snake swallowing something whole. You can see the bulge move from one part to the next. Energy reprices trucking. Trucking reprices. Manufacturing reprices. Construction reprices housing. Then all of it rolls forward into the consumer economy. That is what is happening now. And once you see it that way, the lie in the headlines becomes obvious. The war does not need to continue for the shockwave to continue. Oil does not need to go back to 140 for the damage to keep traveling. The system already swallowed the first bite. That is the second rule. Once the cost has entered the pipeline, ending the trigger does not reverse the flow. Let us stay with trucking for a moment because that is where the average person still underestimates how broad the damage can become. When shipping gets repriced, it is not just luxury goods or imported nonsense that changes. It is everything that moves food-building materials, consumer staples, industrial inputs, machinery, appliances, seasonal inventory, household basics. Every product that gets hauled on a truck now carries a little extra cost. If it moves by sea, the problem begins earlier. If it moves by road, the problem arrives later. Either way, the person who pays at the end is usually the one farthest from the point where the shock began. Manufacturers then get hit next, and this is where the timing becomes brutal. A manufacturer often cannot just wave a wand and instantly reprice what he sells. He has contracts, he has wholesale schedules, he has agreements he signed months ago at old assumptions. So the shipping cost rises now, but the revenue side does not catch up immediately. That means the margin gets squeezed in real time. The cost is current. The pricing power is delayed. That delay is where balance sheets get wounded. And this is one of the reasons I keep telling people the inflation you feel 6 months from now is often already locked in today. The manufacturing side has already started absorbing the higher cost. It will pass it on at the next pricing cycle it can manage. So the shelf inflation that looks like it suddenly appeared later was actually baked in much earlier when the cost structure shifted upstream. That is why I pay so much attention to pipelines and not just prints. Now we get to the part almost nobody talks about carefully enough: construction. This is where the shockwave becomes vicious, because construction runs on contracts, and contracts do not care that oil had a bad month. If you are a contractor and you signed a fixed bid deal months ago, you are legally committed to complete that project at the terms you agreed to, even if the inputs underneath you get repriced higher. Lumber rises, steel rises, transport rises, equipment costs rise, subcontractor pricing shifts. The client does not call you up and offer a kindness premium because the world got more expensive. The contract is the contract. That means thousands of contractors can be working every day and still losing money, not on a theory, on real jobs. Every morning they show up and burn margin. This is why I think the home building index matters so much. It is one of the clearest live signals of where the economic wound is opening before the average household sees it. In the source material, the home building index is still hanging near its March lows even after the ceasefire. That matters. The market is telling you something very plain. The military headline changed. The business damage did not. That is the third rule. When the market refuses to celebrate after the headline improves, it is because the real wound is deeper than the headline. Construction is where that wound becomes visible because construction lives at the intersection of material prices, labor, financing, fuel, and contract rigidity. It is one of the first sectors where a shock like this stops being theoretical and starts becoming bankruptcy math, and then, of course, construction pushes into housing. So by the time ordinary people ask why home building is slowing, why quotes are being revised, why projects are stalling, why new builds are more expensive, why repairs cost more, and why housing feels stuck in another kind of squeeze. The shock wave has already moved from energy to trucking to manufacturing to contractors to housing. That is why I say it is coming for you whether you see it or not. If you live in the economy, you are standing somewhere in this chain. Now let me turn to the Federal Reserve, because this is where the shock wave stops being a cost problem and becomes a policy trap. The Fed has one main tool. The price of money rates go up, and in theory inflation cools because borrowing slows, spending slows, demand cools, and the economy gets less hot. Rates go down, and in theory the economy gets stimulated because borrowing gets cheaper, activity rises and pain eases. That is the clean textbook. The real world is uglier. What happens when you have inflation pressure and economic weakness at the same time? What happens when the inflation is coming, not because everyone is partying too hard with cheap money, but because the supply side of the economy has just been repriced and the cost shock is already moving through real businesses? That is where the Fed is stuck now. They have two doors. I want you to picture them clearly behind door number one. They raise rates to fight inflation. That sounds responsible. But what are they actually hitting? They are not just hitting a speculative bubble or overexcited consumers. They are hitting businesses that are already being crushed by higher input costs. They are hitting contractors who are already underwater on fixed bids. They are hitting manufacturers whose margins are already being chewed up. They are tightening into a structure that is already choking. That is how you turn a shock into a recession. Now look behind door number two. They cut rates, hold easier, or otherwise support growth. They cushion the pain. They protect employment as best they can. They keep the machine from seizing. That sounds humane. It also means inflation gets more room to breathe. The dollar loses purchasing power faster, and the money you saved buys less each month. Those are the doors. Neither leads to comfort. That is the fourth rule, when inflation is baked into the supply chain and weakness is already in the economy. Monetary policy stops being a solution and becomes a choice about who gets hurt first. And once you understand that, you understand what the Fed usually does. It chooses door number two every time because recessions are loud. They happen on somebody else's watch. They create headlines, firings, political blame, and visible pain that arrives on a timetable politicians can understand. Inflation is different. Inflation is quieter. It is distributed. It shows up in 1,000 small humiliations instead of one giant dramatic collapse. It can be blamed on oil war, supply chains, greedy companies, weather, anything except the people who keep expanding the money supply and protecting the debt structure behind the curtain. That is why I call it the principle. Agent problem. It is your purchasing power. It is your retirement. It is your bank account. But the agent making the decisions does not share your exact incentive. The agent wants to avoid the public disaster. You want to preserve your wealth. Those are not the same objective. So when the trap gets tight, the system chooses the slow confiscation over the public collapse. That means more debt, more deficits, more accommodation, more money created to service a system that is too indebted to endure real tightening for very long. This is where the first shock wave, the energy shock wave, gives birth to the second one. The first wave moves through the real economy. The second wave moves through money. And the second wave does not hit all assets equally. This is where the market splits. Most people do not understand that because they still think money printing is just broadly good for markets. That is too simple. Money printing is not a gift basket. It reaches assets differently depending on what those assets actually are. Now let us start with stocks. What is a stock? It is not a piece of paper with a ticker on it. It is a claim on future earnings. That is the essence of it. When you buy a stock, you are buying discounted future cash flows of a business. So what happens when the shock wave hits those businesses before the Fed rescue arrives? Margins get compressed. Contracts go underwater. Costs rise faster than pricing power. Hiring slows. Expansion pauses. Earnings get damaged. That is happening now. So stocks get hit first, not because the Fed will never ease, but because the earnings damage arrives before the easing does. And that timing matters enormously. By the time cheaper money shows up, the business may already be impaired, the contractor already lost money, the manufacturer already had 2 bad quarters. The retailer already absorbed the higher shipping cost, the operating machine already got dented. Cheaper money cannot magically undent the machine. It may support multiples later, it may cushion the valuation damage, but it does not instantly repair the profit engine that the shock wave already bruised. That is why a rally in stocks during these moments can be so deceptive. You may get a bounce on hope, on headlines, on anticipation of easing, but if the rally comes on poor breadth, weak volume, and narrowing participation, then the market may simply be setting a trap for people who confuse temporary relief with repaired fundamentals. That is what I think the source material is pointing to when it describes the SP below its 200-day moving average and recent rallies occurring on thinner participation. The market is not healed, it is reacting. That is the fifth rule. Stocks need functioning earnings power, not just cheaper money. Now let us turn to Bitcoin, because this is where the story becomes much more interesting. Bitcoin has no income statement, no quarterly margin compression, no supply chain, no fuel surcharge problem, no contractor exposure, no employees to lay off, no fixed bid contracts going underwater, no inventory to reprice, no earnings miss. That is what makes it different in a shock like this. Stocks sit downstream from the real economy. Bitcoin sits outside that earnings machinery entirely. So when the Fed chooses door number 2, the money does not have to pass through a damaged business model before it reaches Bitcoin. It moves directly into a scarce monetary asset with fixed supply. That is a completely different setup. The same shock wave that damages corporate fundamentals is the one that ultimately pressures policymakers toward debasement. And debasement is exactly the sort of environment Bitcoin was designed for. That is why I say the same event can be bearish for one side of the market and bullish for the other. The inflation shock wave crushes earnings, sensitive assets first. Then the monetary response fuels the scarce monetary asset, that is the split. And it is not a coincidence. It is the mechanism. Now, I know plenty of people will say, fine theory, but where is the evidence? That is a fair question. The source material uses one metric I think is genuinely worth respecting. Bitcoin S2 year rolling return. It asks a simple question every day. If you bought Bitcoin exactly 2 years ago, are you up or down? Across thousands of trading days, that line has only dropped below zero a handful of times. And in the source framework, it has now dipped negative for the 4th time in Bitcoin S history. That matters because the previous 3 times coincided with brutal sentiment resets that later became extraordinary accumulation zones after the 2013 collapse, after the 2017 collapse, after the 2021 blow-up and the FTX era discussed. Each time people said it was over. Each time the negative 2-year return zone marked a period when the asset looked broken to the public and became highly interesting to the patient accumulator. Now, I am not saying history must repeat in the same percentages. That would be childish. Bitcoin is bigger. Now the buyer base is deeper. There are ETFs. There are public companies holding it. There is institutional infrastructure that did not exist in the earlier cycles that changes the shape of the move. But the setup still matters. A scarce asset with fixed supply, no income statement, and rising institutional adoption behaves very differently from a stock index full of businesses being hit by cost shocks. That is what the public keeps missing. And once you add the institutional behavior on top, the picture gets clearer. When major corporations, public funds, and large investment vehicles keep accumulating in the middle of the monetary setup I just described. That is not random enthusiasm. That is capital reading the same pipe. Now, let me bring this all together. We began with a contractor losing money on a job. That sounds small. It is not. It is the entire story in miniature. The contractor gets hit because materials and transport were repriced. The manufacturer gets hit because inputs rose faster than revenues could adjust. The trucking company repriced everybody upstream. The consumer gets hit later. The Fed gets trapped between recession and debasement. It chooses debasement. That debasement hurts earnings, sensitive assets first, and fuels scarce monetary assets second. That is the full chain energy shock, supply chain repricing. Margin damage, policy trap, money supply expansion, market split. Once you see the sequence, the whole economy looks different. And most importantly, your decision-making looks different. You stop expecting the ceasefire to save you. You stop assuming a stock bounce means the earnings damage is over. You stop thinking all assets benefit equally from monetary easing. You stop treating Bitcoin like just another risk trade. You start seeing why a scarce asset with no earnings exposure and fixed supply can sit on the opposite side of the same shockwave that is hurting ordinary corporate cash flows. That is the point. Now, none of this means certainty. Nothing does. Stocks can still rally sharply on policy and optimism. Bitcoin can still be violently volatile. The timeline can always stretch longer than the impatient want. But the mechanism matters more than the mood. And the mechanism says this. The first shockwave is already in the economy. The second shockwave is coming from policy. The first hurts earnings. The second rewards scarcity. And if you are sitting in the middle pretending the crisis ended because the headline softened, then you are probably standing in exactly the wrong place while the whole sequence keeps moving toward you. I would rather understand the sequence than trust the mood. That is how I have always tried to survive markets. Not by believing the loudest story, by following the mechanism all the way through. That is what this is, a mechanism, and it is already in motion.